Oppenheimer's John Stoltzfus lowered his year-end S&P forecast to 4,400 from 4,900, and strategist Ed Yardeni said that the index probably won't recoup the 10% drop from its July peak before year-end. So as earnings season blazes on, and of course the Fed makes another interest rate decision, should investors run to safety? Let's bring in Keith Bliss, BloxCross Global Head of Markets and Strategy. Thank you for joining us this morning. So Keith, what is the move here? Where do you invest in this sort of volatile market?
Well, right now, and Jared actually stole some of the things that I was going to talk about today. Jared and I speak quite often and compare notes. But right now, I think the setup is to go long equities across the broad platform in construction inside of cash equities in the U.S. A lot of the things that we were talking about with seasonality do hold up. Patterns repeat themselves. And we've had the broad market indexes, mostly the S&P and the NASDAQ, in oversold readings since the middle of last week with the quantitative models that we design and we look at and we structure and follow the markets with. At the same time, the VIX has gotten overbought. So when you have that set up, you have the seasonal factors in play, you have reversion to mean trades that are primarily driving the market right now. I think you can get long U.S. equities here despite the sell-off that we've experienced in October.
So, Keith, let's kind of break down that play. I mean, if you are going long U.S. equities, what sectors right now hold the most value?
Well, the sectors that are the most oversold right now are the healthcare, specifically the biotechs. If you look at some of the NASDAQ biotech indexes, they've been persistently and painfully oversold for some time. I'm not sure I'd start dabbling a lot of money in there because I really don't see an extreme bounce back coming. Those stocks are down for a variety of reasons, but mostly around regulation. Inflation is impacting them, as well as innovation, which is coming into some of the names, as well as FDA approval. The banks are another place you may look. They have been persistently oversold. But again, that is an economic play that people are concerned about, have been for most of the year. So I think if you got into metals and mining, if you got into some of the commodity space, oil has been oversold, and certainly we would expect that to lift. Especially if the geopolitics continues to heat up in the war in the Middle East. Unfortunately, if that expands, that will certainly drive commodities prices. Those are the places that I would look at, as well as general industrial types of names. Caterpillar reported today, and their earnings were not great, but they see that they are going to be growing into the future. So I think that's a name that you could get in on good value. Certainly value names are the place to go right now, Kiko. The growth indexes have just been hammered recently because people are concerned about growth. Maybe not through the end of the year. The economic data has been good, despite what most analysts would tell you is going to happen in the future. But I would say away from growth names, going to value names, consumer durables, and things of that nature.
And Keith, you mentioned geopolitics as one of the risks here, and it did take months for markets to really even come to terms with what the Fed was consistently saying about a higher for longer rate environment. What do you think are some of the risks that the market is still discounting at this point in the year?
Well, I think they're still discounting the overall inflation picture. We're starting to see the cracks in the consumer, as you just reported, or will be reporting. Consumer debt is lifting. Desaving has been going on. All you have to do is go to one of your local merchants and see the increase in prices, especially still around food inflation. It's pretty dramatic if you go to your grocery store or even to a Costco or Sam's Club or things of that nature. So I think the market is still discounting what the inflation picture is going to look like, and then by extension, what the rates picture becomes into 2024, maybe even 25, and as a result, what it will do to force the Fed's hand. Rochelle, the stock market hates two things mostly, and that is an increasing rate environment and a lack of earnings. And generally, they go hand in hand, especially in the financial sectors. So the market's not really come to grips with that. As it relates to geopolitics, the situation going on in Israel and Gaza is different from Ukraine from the standpoint that the flare up in that region, moving into a full shooting war, incorporating other players in that region, maybe even the U.S., that has the impact of spilling over across a wider area of the region and then impacting the most valuable commodity we have on the globe right now, which is oil. So that's why I think people are paying more attention to what's going on in Israel than they did with what's going on in Ukraine. And those are things that we're going to have to keep an eye on. How long this lasts? How does it spill over? Does it impact our ability to produce oil? What happens to the oil markets? And of course, as we know, if oil does get up to $150 or higher a barrel as a result of this, then that just ripples down through all economies and inflation, and that will be very bad for the consumers globally, and then as a result, very bad for cash equities.
Keith, bringing the conversation back to the U.S., we've got a House Speaker in place now, but we're a few weeks out from another deadline, November 17th, of a potential government shutdown. How big of a risk do you think that is for the market?
Tough to tell right now. We'll see what happens with Speaker Johnson and how well he's able to negotiate, not only with his own caucus, but also with the White House to avoid something like this. I mean, the mere fact that we got a speaker, I think, was finally a result of the politicians, especially the maverick politicians in the Republican conference, looking at the polling numbers and seeing that Americans were frustrated and tired of this nonsense going on down there, put a speaker in place so they can start doing our business again. But as it relates to the conversations around increasing the debt ceiling and therefore keeping the government open, I think we're still, not on firm footing when it comes to those negotiations. Again, those mavericks that delayed us putting a speaker in place, they're still going to, gird for the war that's coming on this. They want spending to stop. They want the deficit to be decreased and cut. And continually raising the debt ceiling, especially with the spending programs that have been put in place the last 3 years, that's going to be a tough negotiation. So I think, like they do every time, they'll walk us right up to the brink. We'll probably get another continuing resolution. But up until that point, you can expect markets to gyrate, especially as we get closer to that deadline.
Indeed. Well, appreciate you joining us this morning with your insights. Keith Bliss, BloxCross Global Head of Markets and Strategy. Thank you so much.
My pleasure.